Remember what I said before, whatever you do in a bar chart, don't give it up. If you do, you're really giving up very valuable information. Although there's really no reason to use bar charts, in fact, it's dangerous. I mentioned before it's dangerous. That's very different than saying don't use bar charting techniques. So here we have a classic resistance area, and we have the doji confirming the resistance. This is the power of adding Western technicals to candles, which we'll be looking at in a lot of detail later on. Now, one of the questions that were asked is that how do we know a signal is false? Not every signal is going to work out. Candles are not perfect. What we could do is use the doji or the prior candle as a resistance area. So for example, what we do is we take the highest high, and this is going to get back to the question about making a high during the doji session, and use that as resistance based on the close. So for example, which of these two candle lines, we look at the doji and the immediately preceding candle line, which of these two candlestick lines has the higher high? Right. So that becomes resistance, our resistance area. As long as the market doesn't close above that, if you're short, you stay short. Normally, unless the candlestick signal confirms something else, I would use it to exit a position. But if you fundamentally, nothing wrong with looking at the fundamentals. If you're fundamentally bearish or you have other Western signals that say, hey, I want to sell short on the doji, that is your stop out level. Now, I'm going to extend the upper shadow. Okay, this is the question before. What happens if the upper shadow makes a new high? What we then do, which has the higher high, the doji or the prior candle? Which becomes resistance? The doji. This will help separate you from the competition. Remembering that we could use candlestick signals to use them as support or resistance. Okay, there's always a price that says we're wrong. A close above this high is telling us that we would be wrong if we're short. So, for example, I'll go back. Let me go back a couple of slides here, show you something really interesting. Okay. So the question before on this chart, this is back on slide 11, is how do we know for confirmation? What do we do for confirmation over here? Remember, a spinning top and a doji, I view the same thing on Forex. One of the options is wait for a lower close. The other option is if you don't want to do that, you set your stop out level. What's your stop out level? Up there. Yes?
For your stop level, do you want to go, in the Forex market, do you want to go 5 pips above the high, 10 pips above the high?
Okay, the question is stop. I usually suggest anywhere from 10 to 20 pips. Be real careful around. The challenge with Forex is because it's so highly leveraged, and people use stops, and you really have to because of the leverage. That means the intermarket people, the dealers, the people who, the banks, they gun for the stops. And if you're, for example, by the zeros, it's normal retail to put a stop in at a zero. They may gun for the stops, and you get above it 5, 10, 15 pips, and then they're just going to turn around. So if you buy the zeros, I would probably give it 20 pips. It all depends on your risk-reward also. A vital concept is risk-reward analysis, and we're going to talk about that later in the session. But if you want kind of a rough ballpark, it would be that. Yes?
And also you need to add the spread difference.
Yes, the spread difference, exactly.
If you say you want 5 pips above your
Right.
make sure you add the spread difference.
Yeah, that's a great point. Make sure the markets are mainly tight 2 or 3 pips, but if you trade some of the less active ones, you're going to increase the spread. That's a very good point. So, yeah.
Does that vary by the length of the session, candle? I mean, the time frame of the candle?
The 10 to 20 pips, the question is, does the 10 to 20 pips stop at level vary according to the time frame? Meaning, if we're looking at a daily or an intraday, definitely. My feeling is, I just gave a rough ballpark, 10 to 20, because that's what a lot of the institutions will use. They'll use mainly daily charts. But I think it all is going to depend. I know it depends on your risk reward. If you're looking to make only 20 pips on the move, you're not going to give it 20 pips leeway. And actually, that'll be something good to focus on when we talk about the risk reward. How much leeway should we be giving? Okay, so let's move on. Okay, so now we've looked at using doji as a resistance area. So here we have the doji. As resistance, and this is one of the challenges. See how the market got above the resistance area but didn't close above it? Okay. Many of you are probably aware that the markets could get above resistance or below support on an intraday or, a daily or an intraday, and if it doesn't close above or below it, it's still valid. Okay. So that is why normally when I talk about a stop-out level, if you can risk it, we're talking about a close.
So can you say doji is used more for figuring out if the market is breaking up or down rather than saying this is a reversal signal?
All right, the question is, can we use doji for saying the market is going to break up rather than a reversal signal? And the answer is yes. Spoken like a true politician. Reversal signal. The trend has gone from up to neutral. The odds of the turn have increased on this day as compared to this day. Okay, so we're using as a potential reversal. And in that scenario, this is our stop-out level. Okay, I would normally not recommend selling on a doji unless it's confirming a resistance area or some Western signal. Getting back to the great question about can we use it as a continuation signal? Because we've now set a stop-out area based on the doji, what we've really done is also, for those who trade with momentum, which is a great way to trade, buying on breakouts, nothing wrong with that. You know, we're looking mainly at reversals, but you can use the candles for momentum. In this sense, if the market closes above the high of the doji, it's a bullish breakout. I would be thinking about buying. The Japanese say the market, with the doji, the market is tired. When the market breaks the resistance area, the market's refreshed. That's your buy point. I would, under no circumstances, buy in the doji. Okay, let the market prove to us that the bulls are in control of the market. How? By closing above the high of the doji. Here, for another example,